Hey, welcome back to Heard It from the CFP. My name is Matthew Coyle, episode 58, 59? I don't even remember. Anyway, it's almost Thanksgiving. How about that? Let's dive in. We're going to talk about end of year planning, and we're going to talk about the market and where we stand as we come up on Thanksgiving 2022. Let's dive in. Okay, it is Thanksgiving, and whether you're seeing this video before Thanksgiving or after Thanksgiving, because we're just coming up on it, I hope you're either going to have a very nice Thanksgiving and wish you a great Thanksgiving, or I hope you had a very nice Thanksgiving. That's the problem with making videos around the holidays. You never know when they're going to watch it. So, hope you had a nice Thanksgiving, or you're about to. Let's look at the market. Where do we stand in 2022? I thought I'd put a few charts out there. Hope you like charts because you're about to get some. And then we'll talk about some year-end planning. Maybe you can take advantage of some of these things that are going in the market. Been a very strange year. And we are going to start right there with 2022. I wanted to capture a chart that I thought just absolutely summed up 2022 and where we stand right now. Again, we have about 1 month to go. Where do we stand with stocks and bonds in the market? Here we go. I'll put this up on the screen. What an outlier. You can see how much of an outlier 2022 actually is. In many ways worse than 2008 just because there's no place to hide. But there you see on the x-axis on the bottom, plain old Business School 101 graph. On the bottom, you've got your S&P 500 returns as of the end of October 13th. And you've got bonds on the y-axis there. Kind of speaks for itself, really. That is an outlier if there ever was one. Good news is things tend to get better. I'll put the next chart up here because this is quite interesting. Found this on Bloomberg not too long ago, Standard & Poor's not too long ago. And when the S&P 500 is down more than 20% since 1950, after drawdowns of this magnitude, what have you typically seen in the past? This is what you've seen in the past. This is the actual data, 1 year, 3 year, 5 and 10 year forward from those drawdown dates. Very, very interesting stuff. Makes my case that I always make to my clients and to everybody who will listen that you need to be in the market and you need to have time spent in the market, and it's better than trying to time the market, although you can time the market from time to time. It doesn't work all that often. So get your money in the market, keep it there, especially now with things being down. Very interesting data there. Where do we stand on rates? What's causing all of this? Well, rates are causing all of this. Why has 2022 been such a weird year? Because rates have been a very strange year. Here's this comes from the FRED database. This is the Federal Reserve database. You can look up the 10-year real interest rate, bottoming out roughly there in early 2020, and now the highest or one of the highest and fastest rate increases we've seen ever from bottom to top. And it's down a little bit, but 10-year yield is still pretty elevated from where it was back in 2020. So when rates go up as quick as they have, it makes pretty much every asset just worth a little bit less, unfortunately. That's just kind of how it goes. And you have to take some of these times with the bad times and the good times, right? Write them out. So what else is going on in the economy? Well, Bloomberg was out there not too long ago putting out the Bureau of Labor Statistics data showing that we are actually seeing cost pressures in the economy go down. You may not believe it when you go to the grocery store. I still have trouble believing it. But if you look at a lot of these things like lumber, copper, steel, cotton, a lot of these things that go into the products that we buy and the products we make, they are coming down in price. And we see this in the actual PPI, the Producer Price Index. This is not the CPI, this is the PPI, okay, Producer Price Index, what it costs to make stuff. And we are seeing these costs come down as according to the BLS, the Bureau of Labor Statistics, which keeps pretty darn good data on stuff like this. So nice to see that. Maybe that'll start filtering through at some point. Historically, where is your best part of the market since 1995? This comes from Morningstar. If you're going to be picking anything now with markets down and markets a little bit cheaper, where should you go? If history is any guide, you want to get out of cash, you want to get out of any of those conservative investments if you don't need them, or if you're getting to the point where you have enough cash and you want to look for something else. Because as we all know, once you get past your propensity to spend something, you are into an effort of capital allocation. When you get into capital allocation, you need to allocate with your best odds of success. And these historically have been, you can see that, again, the chart kind of speaks for itself. On this chart, you want to be lower and to the right. And if you have questions on what might be appropriate for you, you can certainly reach out to us. But historically, those have been your best places to be post-1995. So with a little bit of background, let's look at a couple things that you might want to think about doing before the end of the year. With stocks and bonds being down this much, okay? What do you do at the end of the year to maybe turn some lemons into lemonade, take advantage, whatever, substitute your metaphor, whatever you want to say. What could you do to take advantage of this? Let's look at that now. Okay, so how can you take lemons and turn them into lemonade? How can you take advantage of a market being down? Because markets are down periodically. 15 to 20%, it happens, and you're going to have that as an investor. It just is part of the game. Nothing goes up forever. So how can you take advantage of a market being down? Number one, we'll start with the low-hanging fruit, right? We're going to harvest some losses. Let's say you have a taxable investment account outside your qualified plan or outside your IRA, because I'm not talking about those right now. You can't harvest losses for tax purposes inside of an IRA or a qualified plan. That money just kind of does its thing and you add to it. If you have investments outside of that, let's say you have in a taxable brokerage account or some kind of a trading account, maybe you're playing around with a little bit of extra money, or maybe you inherited some assets, or maybe you've got some assets built up in another taxable account outside of all that stuff, you need to take a look at the cost basis and the gains and losses in that taxable account and see if you can harvest some losses. What do I mean by that? Well, the IRS code does allow you to deduct capital losses up to $3,000 against your income if you have losses in that area. Now, you can't do it from an IRA or a 401k or a Roth or whatever, but you can do it from a taxable brokerage account up to $3,000 per year. How do you do that? Well, basically what you do is you take your short-term gains and losses in one pile, your long-term gains and losses in another pile, you net those out, you'll get a result there. Those results offset and go down to the next filter, whatever the difference is between those two. You can deduct up to $3,000 per year against your income and capital losses. Anything more than that carries forward, okay, for future years. If you have a gain from all that, you have to recognize the gain, obviously. So you only want to do this if you have losses to harvest. Do again, short-term gains and losses, long-term gains and losses, you net those two. That drops down to the next filter. You then net out the result right there, and whatever the result of that is, you can up to $3,000 take the loss. Anything more than $3,000 carries forward. And of course, any gains, you're going to have to recognize those as capital gains according to the IRS code. So you might want to harvest some losses if you can do that. If you don't know how to do it, it can be tricky. Be careful before you make any sales. Reach out to us. We can help you. Other than that, it might be something you might want to look at. All right, next, rethinking your allocation. I see a lot of investment accounts in this line of work, and a lot of them, frankly, I just don't like how they're allocated in their taxable accounts. Now, again, we're not talking IRAs, we're not talking 401ks, we're not talking Roth IRAs, not talking any qualified plan or retirement stuff. What we're talking about is anything outside of that in a taxable brokerage or additional investment account. Historically speaking, the most tax efficient way is not to own mutual funds in a taxable account. I see people take capital gains that they can't spend and have to pay taxes on every year because they're allocating certain monies to certain investments inside taxable accounts, and usually they're mutual funds. They are not the most tax efficient structures to hold in a taxable account. You may want to stick to ETFs or individual securities if it's appropriate for your risk profile, full disclosure, okay? So if you have taxable investments like mutual funds in a taxable account that have pass-through capital gains, unless you're holding it for a very specific reason or unless you can't really get anything else as far as exposure for that particular asset, maybe you just really like that fund, I get it, but for the most part, I've seen some people take some pretty big taxable events in years, even when they don't sell mutual funds in a taxable account because they have pass-through gains. So you may want to take this time, harvest some losses. In addition, maybe think about reallocating your account if you can do it. If you can strategically move out of those funds and maybe into an equivalent ETF, if it's appropriate for you, exchange traded fund, ETF, maybe that would be the right thing for you this time of year to do. Again, ask your advisor or ask us if that's appropriate, but you may want to rethink your allocation for future years so that when markets do eventually come back, and I think they will, you will not have pass-through gains you have to pay taxes on without getting to enjoy the gains, right? All right, next one. This one should be pretty obvious, right? Buy more. Add money to your investment accounts. This is a great time to do it. Historically, being down 20% happens every probably 12 to 15 years. It just happens. And this is the time when you make your money. You make your money in the buy in this business, not in the sell. There's a very, very famous quote from JP Morgan. I'll put it on the screen here. In bear markets, stocks return to their rightful owners. I absolutely love that quote. It's one of my favorite quotes of all times in the world of finance. So add more to your investment account. Take some of these names or these industries or these sectors or asset classes, even a broad index fund that's just been beaten to pieces, and buy it. If you want to have some ideas, maybe reach out to us. I can tell you right now that the small and mid caps are the cheapest part of the market. Large cap is still relatively not cheap, but it's come down quite a bit. So when you look at these things, look at what's likely to make me money over the long term. If you have 5 years to go in the market or more, you absolutely must be adding to your investments right now. Everybody who makes any money in the markets at all looks at this as an opportunity, not as a threat. Okay, next up, consider a Roth conversion. And I mean by a Roth IRA. If you have an individual retirement account, let's say you have an IRA or a rollover IRA, any traditional IRA that's pre-tax, you can take that money and you can convert it, regardless of your income, into a Roth IRA. Now, you will pay tax on any money you convert in the year you do it. They'll be added to your income at your marginal rate, your highest rate for the year, right? But it could be worth it, given the fact that tax rates are historically fairly low. It's nothing like we saw back in the 60s or 70s, of course. But it might make sense for you to consider a Roth conversion. Now, why would you do that? Well, there's one big reason why you would do that. You want to move your growth assets into a more preferable area as far as tax friendliness, right? So what you're doing with a Roth IRA conversion, you're taking IRA investments and converting them or moving them over to a Roth IRA for the purposes of better taxation. No taxation on the growth and no taxation on the exit. This differs from a traditional IRA where you do have taxes on the exit. When you pull it out, that will be a taxable event as far as income, but you still get tax deferred growth. But there's no tax in a Roth IRA in the growth, and there's no tax on the exit, So when you start pulling funds out, it will not be taxed. You want to take your highest potential growth investments if you do this, and you want to move them over. You would not convert bonds or conservative investments to this. You really want to do this with equity, with stock investments. Oh, there's Leo. Hi, Leo. He's leaving. He's tired of hearing me talk. He probably gets tired of hearing me talk. It's just how it is. It's fine. He'll be back. Anyway, if you do a Roth IRA conversion, convert your equity, your stock investments, to a Roth IRA if it's appropriate for you from a tax perspective. There he is again. Consider it. If you have any questions, yeah, let us know. Thanks. And finally, I'll put this last one up there. I'll call this one Keep Your Head Up. Keep a long-term perspective. Understand where we stand in the bigger picture, and that things, as well, they can be challenging at times. They're not historically all that bad. We've actually seen a lot worse than this, a lot worse. I'll put a couple more up here for you to see. Total non-farm payroll. We are basically at full employment. At this point, we are basically fully employed in the economy. In fact, I have not traveled. I travel a lot around the country, typically every year, and I have not seen more help wanted or more help needed signs than I've ever seen at this point right now. If you want a job, you can find a job. You may find it beneath you or not, I don't know. But if you want a job, it's available for you. They're out there, and most everybody now is employed if they want a job. I'll put another one up there for you, and that is, of course, weekly earnings. Weekly earnings, as measured in the aggregate in the economy, continue to rise. We're basically at full employment. Most people who want a job have them, and earnings continue to rise in the economy according to the Federal Reserve, which again keeps pretty good data on this kind of stuff. So historically, we are not in a bad shape or not in a bad way. This is basically interest rate driven, as when those things happen and as they slow down, it should get better, but just, all assets tend to do poorly. I shouldn't say all, most assets tend to do poorly when interest rates rise this quickly, just because the cost of money gets repriced. So keep your head up, keep a fresh long-term perspective, keep adding to your investment accounts, and I will see you next time. Again, I wish you a happy Thanksgiving if you're about to watch this video or about to have Thanksgiving, or if you just had it. I hope you had a great Thanksgiving, and I gotta stop making videos around the holidays too close. So have a good one. Take care, and as always, your most valuable asset is your time. I always say it. Thanks for sharing yours with me. I will see you next time. Bye.